Okay. Welcome everybody to this Left Field Investors Lunch and Learn, and welcome Matt. Thank you for being here. Today, Matt is going to talk about real estate investing for the busy professional, and I am sure he's going to introduce himself, but I will say a couple of things. I was so pleased, Matt, to see you in New York last week. I messed up because I just remembered him living in Boston, and then I saw him in New York, and we should have had dinner, but we didn't. So next time. But Matt Picheny is an author, and I don't know if you can see this. Not very well, but I do have my book here, Matt. I just have my screen. Maybe you can do it.
Yeah.
There we go. Fantastic book. Thank you. I recommend reading that. He's also an operator with his company, Picheny. He's a passive investor like the rest of us. He is a left field investor member. He's an infielder. He is a left field investor preferred partner as an operator, and he is speaking at the meetup in the Left Field 2022 in a month, exactly a month from today on October 21st. So Matt is a fantastic partner to Left Field Investors. He's a valued member. We appreciate everything he does, and he is going to chat with us about investing for the busy professional, real estate investing for the busy professional, which all of us are. So Matt, with that, I will turn it over to you.
Wow. I don't know if I can live up to that introduction, but thanks, Jim. It was great to see you here in New York. It's great to see everybody here. I see a couple of familiar names on the screen. I would say faces, but there aren't very many faces, but some names of people that I know. So it's good to see you guys here. I guess without any further ado, I will, can I share my screen, Jim? I don't have the ability to do that at the moment.
Sorry about that. I am doing that now. I forgot to do that. There, you should have it now.
All right. Yep. Here we go.
Excellent.
So you guys should see my screen. Real estate investing for the busy professional. Thanks. So yeah, Jim and I were talking about doing a lunch and learn and trying to figure out what's going to be something that's really valuable for the community. And he said, we have a lot of people who are sort of newer to real estate investing, and maybe you could do sort of a primer. So what this is it's just going to kind of run through everything about real estate investing, at least get whet your appetite a little bit. Just a couple of disclaimers. If you've ever seen one of my presentations before, I always use this slide because it's really important for everyone to know that I am not a CPA. I am not an attorney. And so I'm not giving you any professional advice. You should go to professionals for advice on all of these types of matters. But I'm just going to tell you a little bit about my journey today. I am, as Jim had mentioned, a real estate investor. I'm also a Tony Award winner and an author of the #1 best-selling book, Backstage Guide for Real Estate. And I'm just really passionate about helping people create financial freedom through passive investment. Okay, I've been doing this for a long time. I've been involved in real estate for over 15 years, kind of doing sort of everything in there, and I've done a bunch of stuff, and I've invested in over 10,000 apartment units. It's actually a little over 11,000 as of the last count, and 2/3 of that portfolio are deals that I am a passive investor in, and then there's a third that I am a general partner on. So I went from being an actor back when I had a lot more hair than I have now, back in 1994. To being a real estate investor with a pretty big portfolio. These are my principal deals as a portfolio. Sorry, this is my portfolio as a principal. And I've also written a book called Backstage Guide to Real Estate, which takes you along that journey from being an actor, knowing absolutely nothing about real estate at all the way to where I am now. And in the book, I share the different keystone concepts that I learned along my journey. I also have 60 different real estate terms that are defined in the book. And so it's a fun, interesting read. There's some humor in there, but it's also educational as well. In the book, I talk about my days in the advertising world. From 1998 to 2016, I worked in advertising here in New York City Picheny Productions, you might recognize that. That's a firm that I had started. But beyond that, I worked at some really big, top-notch agencies in New York. And what I did at all these agencies, I was a project manager. And one of the things that you learn about as a project manager is this thing called the project management triangle. Okay. And so the project management triangle is talking about time, quality, and cost. And, you know, if you want to make something happen faster, you're either going to lose quality or it's going to cost more, right? They all kind of work together as a triangle. If you move things up or down, the other two are going to move in tandem with it, right? If you have an endless amount of money, you're going to have great quality and it can get done really fast, right? So they all sort of work together. So I've kind of created this thing on my own. I mean, it's not really like a thing, but I like to think of it as a thing. It's the investing triangle, where you've got time, you've got money, and you've got experience. And so just like that, you know, if you have a lot of time, then maybe you don't need as much money or as much experience. If you have a lot of experience, you might not need as much time or as much money. They all kind of work together. And the time is something that we really can't control. And money, some people have a lot of it, some people have less. But experience is something where we can all I think, easily level that playing field. And I think experience is probably the most important factor when it comes to being successful in real estate. You can have all the money in the world and be a terrible real estate investor. You can have all the time in the world and be a terrible real estate investor. But if you have a lot of experience, I think that's going to go a long, long way. And so today I'm going to share with you some of my experience in real estate. And for me, it all started with the primary residence. I bought a property in Washington Heights. Now, I know you guys look at multifamily stuff. You might be thinking I bought the whole building. I just bought the little red circle right there. I bought an apartment, a one-bedroom apartment up in the Washington Heights area of New York City. And I ended up selling the property a little over 2 years later. And I saw my initial investment in that property more than quadruple in value, which was the thing that really got me interested in real estate, because I was like, wow, how do I do that again? I had a decent income, I had pretty good income at that time. But that one transaction, I made more money than I made for a whole year's salary. So it was an eye opener. The reasons why the property did so well is I think because of the work that was done at the property. The real estate market in New York City at that time did unbelievably well. So that was definitely a big factor in it. But I think I can also attribute a lot of that increase in value to the work that I did. I got into the place, it was kind of in shambles. There was cracks in the walls, and I hired a guy to come in and do plaster work and patch it all up and give it a fresh coat of paint. It looked really nice. The problem was the lobby and the hallways. The lobby had a couple of like really old pink leather couches that were like, when the leather gets so old, it starts like cracking and stuff. I mean, it was just, the place looked like it had been decorated in 1980 and hadn't been touched since. We went in and it was a co-op. And then there was a co-op board, and I started becoming friendly with some of the people on the board. And then we were talking about the lobbies and the hallways, and they asked me to actually join a committee they had created. And we worked with an interior designer, and we redesigned the lobby and the hallways. And when it got done, the place looked way nicer. It was like more modern. It looked more expensive, and it turned out to be just that. So I did really well. I mean, how did I quadruple my money? How did the math add up? I put $125,000. I bought the property for $125,000. But I only put down $30,000 because I got a loan from the bank, right? I got a mortgage for $95,000. So that's how I had my 125. Luckily, I had $30,000 I had squirreled away. So I put the $30,000 down. And then when I sold the property, I sold it for $255,000. So that was a $160,000 profit well, $160,000, sorry, after paying the bank back, and then $30,000 for the down payment I had originally put. It was $130,000 profit. So it was pretty awesome. And this example doesn't talk about the fact that, you know, I paid down the mortgage over time. There were tax credits, and there were financing costs. But this is just, you know, rough draft of kind of how the math added up on that. And I took all of those profits and I sunk it into another property. Again, not the building, just that one unit down there, another 1-bedroom, but this time it was on the Upper West Side of Manhattan, a much nicer location, and a nicer apartment. And I lived there for a while. And while I was there, I really learned what I share in the book as keystone concept number 5, which is cash flow is king. Because when I was there, we had a nice big recession, and you know, I only buy properties now that generate positive cash flow. What was happening to me there, you know, I lived there for a couple of years before the big crash, but I saw my apartment go up in value quite a bit while I lived there. So when the crash came, the value of my property sunk down, but it only sunk down to right around what I had bought it for. So it wasn't like underwater, which was good. And I knew that all I had to do was pay that mortgage. As long as I paid the mortgage, I was fine. Eventually, the market would turn around, which it did. I ended up selling it several years later and made a very nice return on the property. But that's, you know, I had heard this concept before, but that's when it really came home to me, because I was like, wow, if this property goes down any further, what am I going to do? I'm going to have lost money. But I needed a place to live. And as long as I could make that payment, I was fine. And so that's why cash flow is so important when you're investing in real estate, because the market's going to have ups, it's going to have downs. We might be going into a down right now. I'm going to talk more about that at the meetup in a month. But regardless of whether we're in an up market or a down market, as long as you're making that debt service payment, you're okay. You never lose money in real estate if you never have to sell. So you hold on to it, you make those payments. So having that cash flow, that's going to give you that cushion that you need, that resilience that you need to live through the times when things are a little tougher. So that's my most important. This is one of the guiding principles of all my investments. Cash flow is king. I then got involved in short-term rentals. I actually bought a piece of land, piece of raw land, and built a house. And this is what the house looked like when it was built. And I rented this out as a short-term rental. And I did that for many years. My biggest takeaway from this experience, besides learning how real estate is like literally made from the ground up, we knocked down trees, dug a hole, the whole 9 yards, was that I don't want to be a property manager. Trying to manage a short-term rental that's 2 hours away from where you live in New York City. It was nice to go there once in a while for a weekend here or there, but managing that thing was a lot of work for not a lot of profit. So it was a great learning experience. It set me on the path to where I am today. I learned about so many different things besides the building and the house, how to deal with tenants, how to look at leases, all the fun tax stuff that you need to look at. That's when I first started learning about depreciation. That's when I started using QuickBooks, because I was doing Excel spreadsheets and that kind of crazy. My CPA was like, yeah, you need to get QuickBooks. So this was a great experience to learn about, and short-term rentals can be quite profitable. But the thing, like, if I didn't build this to be a short-term rental. I built this as a vacation home and ended up becoming a short-term rental. The advice I would give people if they're looking at short-term rentals is to make sure that you've accounted for a property manager. This goes for single families as well. Even if it's near you, even if it's around the corner from your house, you're going to want to get to a point, if you're trying to develop passive income, you want to get to a point where you're not going to have to, change those bed linens every time a new person's coming in, or wash those towels, those kinds of things. Deal with people. They lost their key. They don't know how to, believe it or not, a lot of people don't know how to change light bulbs. I don't know how they function, but it's true. Things that happen in the middle of the night, getting phone calls. Hiring professional property manager is something that you want to do, or at least be able to do. If you're going to manage it yourself, as long as you've underwritten it to cover the property management, but you want to do it yourself, go ahead and do it yourself. But as you advance along and get more and more passive income, you're not going to want to be doing that property management stuff. I moved on from there into a chapter in the book that I call the accidental house hack, because this thing called a house hack now, but I didn't know there was such a thing. What I did know was that there was a building that I liked, an apartment that I liked, that was 2 units. There was an upstairs unit and a downstairs unit. And so we bought that property. And by the way, I'm speaking to you right now from that property. I'm actually, that window right down there is right over there. But we bought this property, and the rent income coming from the unit above us was paying for more than half of what our mortgage payment would be. And both of the units are the same size, except the bottom unit has the backyard. Each unit is 3 floors, so each unit has a floor and a half. So our entrance used to be downstairs, and we would come in. We've since taken over the entire property, but so we used to enter from downstairs, and we had a floor and a half, and then the tenants would walk in through here and have a floor and a half. And this is what's called a house hack. So a house hack is when you buy a property that's between 1 to 4 units. You can't go above 4, because then you get into sort of the commercial type mortgages. But if you buy somewhere between 1 to 4 and you can rent out, I know people have done it with a single family house, single people, usually male, although females could do it too if they feel comfortable, and rent out rooms in their house. But traditionally what I've seen this done is, like a duplex like I did, or a 3 unit or a 4 unit. And you rent out the units, and you want the rental of the units to cover at least, in the case of a duplex, at least a half. In the case of a triplex, at least 2/3. In the place of a quad, at least 3/4 of the mortgage payment. So that if and when you might move out of that property, you could rent it out and at least cover the mortgage. I'd like to see it be a little bit more. So the fact that we bought this property and the mortgage above was paying for more than half, and we renovated the unit below, and it had the backyard, I knew we could get even more than what we were getting above. I knew we could rent this apartment and actually have positive cash flow, which is exactly what happened, because we ended up moving, and I ended up renting the unit down below. Well, we've since moved back, but we ended up moving down to Miami, and I rented, so I had both of the units rented and had some nice cash flow coming from this property. So that's called a house hack, is the term that's been coined nowadays. It can be very lucrative. Some things to know about a house hack. You can usually get in there with a very low down payment, as low as like 3.5%, based on the type of mortgage that you're getting. But the thing is, you have to live in the unit for at least a year. So, and if you're doing a low mortgage, you're going to have to pay PMI and things like that. But it can be a good way to get started in real estate. Another way to invest in real estate is a fix and flip, right? I did some of those. This is my favorite one, because the before and after I think is pretty good, right? Here's what it looked like before. Here's the after. Ta-da! We lost money on this deal, actually. See, behind that wall over there, you see that hole back there? We opened it up. There was a bunch of mold. So we had to remediate that mold. That wasn't fun. So, but this is a fix and flip I did. I also did some flips where I made money. But it takes a lot of time. And, we only have a finite amount of time on this planet. Actually, keystone concept number 1 from the book is don't trade your time for money. And all the things that I just showed you about before, right? The house hack, actually living in the apartment, doing the fix and flips. They take up a lot of time. You can always generate more money. You can't generate more time. So what you don't want to do is trade your time for money. You want to try to find ways to create money, income in a passive manner. Okay. Passive income is incredibly powerful and incredibly important. I'm sure you all know that. That's why you remember the left field investors. But it is paramount because it can lead us to financial freedom. If we can get all those puzzle pieces aligned just right, we can achieve that. And then we get the dream, right? Where we make money while we're sleeping. Okay. Now, for me, that sounded like a unicorn, right? It was like a mythical beast. Like, oh yeah, how am I going to make money while I sleep? There's no way that that's possible. That can't really happen. At least it can't happen in any sort of substantial way. But I wanted to give it a shot. So my first foray into this sort of passive income stuff was working with the turnkey rentals. So, I bought this property in Memphis, Tennessee from one of these turnkey providers. Okay. That's me looking all proud in front of my single family there. Cool little 2-bedroom, 3-bath. It's been rented since the day I bought it. And it provides really nice cash flow. And I don't do a darn thing. I mean, I really don't do anything. I have it set up in my bank. Mortgage payment is automatically set up on an ACH. Money comes into my account from an ACH. Like it's all, I really could probably die and this thing would just run on its own for at least for a couple of years. Then I bought this other one in Memphis as well. And so these two properties, I've actually been in them for about 5 years, 6 years, I think about 6 years now. And the cash flow that's been generated from them has paid for my down payment, like all of my costs that I had to set this whole thing up. And so everything that I get is profit. Every single dime that I get is profit. Rents have gone up, so I get very nice profit. And every month the debt gets paid down further. So, oh, and by the way, properties are appreciated quite a lot in value. So, the debt's getting paid down, they're appreciating in value, and I'm getting money in my pocket after all my expenses are paid. Pretty nice deal. So that's turnkey, totally turnkey. The people who do it, they find it, they buy it, they do the rehab on it, they do the property management. I literally don't lift a finger. That's pretty nice. The problem with these is like, I bought this property for somewhere between $70,000 and $80,000. And so while the cash on cash return is like great from a percentage perspective, from a dollars perspective, it's, I don't know, maybe $400 a month, which sounds really great, but you have to realize that you're limited to only get 10 of these. You only get 10 with conventional mortgages, then you're going into a whole different type of commercial financing. So if you have 10 of these, so you're making, what, $4,000 a month. So that's $48,000 a year, which is not shabby. I'm not going to complain about $48,000 a year, but that's not enough to replace what my income was. I was looking to replace my income. So I started to get involved in multifamily. I started looking for something bigger. How do I scale this up a bit? And there's really sort of two flavors when it comes to multifamily. You can go ahead and do your own multifamily deal. This is a 6-unit I have in Kansas City. It's a bit more active. It is a bit more active than the turnkey. I have to keep an eye on my property management company a little bit on this one, make sure they're doing things. But this also provides nice, steady, stable cash flow. And this was a great deal that actually 1031 into. There's a whole chapter in the book about it. It's really fun, very creative deal that I did. So, you can do the multifamily on your own, but if you're really looking to be passive, what I found that works really well is syndication. So real estate syndication, as I'm sure you all know, is when a whole bunch of investors get together and pool their resources to go ahead and buy a property. And I mean, you could do it with a single family house. You could do it with multifamily. You could do it with self-storage units. You could do it for a mobile home park. You could do it for a grocery store. Heck, we've syndicated Broadway musicals. So, I mean, you can syndicate anything. You just get a bunch of people pooling their money and their resources together. And all those people working together, you know, the sum is greater than the individual parts. So I really like it when everybody gets together and sort of collaborates and comes together as a team. I'm sure you know this, but for those of you who don't, a really quick thing, you know, with the syndication, there is a sponsor or general partner. That's a person who oversees the deal, oversees the property, the entity that owns the property. So you know, we've got the sponsor here in blue, and to the right we have the investor. Those are our limited partners who are investing in the deal, and then you have a legal entity, and that legal entity will go ahead and buy the real estate. There's almost always a bank involved to get a mortgage. So the general partners, the sponsors, they're putting the deal together. The investors are just limited partners. They don't really have a lot of work to do, or any work to do, or any say to do, really, in the entity itself. And so that's kind of how syndication works. But when we look at all the different things in the real estate world, you know, we've got short-term rentals, fix and flips, house hacks, you know, buying and holding multifamily or single family homes, all the way down to syndication. And there's a different amount of effort and control, right? So, you know, a short-term rental that you might have, you have a lot of control, or that fix and flip, you have a lot of control, but it's a lot of effort on your end. When it comes to the syndication on the other end of the spectrum, you have little control, but it's also very little effort, and it allows you to have your time back. So, you know, the important thing to do is to adjust your risk to make sure you get as high returns as you can without having, you know, too high of a risk. And the way that I do that, I talk about as Keystone concept number 12. It's the 3 deal pillars. So the 3 deal pillars that you need to look at when you're evaluating a deal like a syndication is the sponsor, the market, and the deal itself. The most important one is the sponsor. That's the most important thing that you're going to want to vet when you're looking at these deals. But, you know, if you're going on a hike and you don't want to get lost in the woods, right? We're on a path here. You're on a path for passive investing. You don't want to get lost. It's always good to have a compass or some sort of roadmap, right? So that you know where you're going. And I do that through setting goals. I think it's really important for you to assess where you are and where you want to be, figure out what that gap is, and write goals down. Write your goals down. Writing them down really helps you understand what they are and helps you track your progress along the way. You know, there's a group that I had been a part of, not quite as cool as Left Field, but a group that I ran in Boston, multifamily group. This is us hanging out one time for one of our meetings. And, you know, a lot of them came up to me and they were like, "Hey, Matt, I really need your help. You know, I'm just getting involved in syndications. I want to do a deal. You know, I want to invest in a deal. I know that you sponsor deals. I know that you syndicate deals, and, like, you know, sponsor XYZ has got this deal, but how do I know if it's good? Like, will you sit down with me? Will you go through the underwriting and help me determine if this is a good deal, if I should invest in it or not?" And I would say, sure. And I would sit down with them. I have to go meet them, and we'd sit down for a few hours and go through all the underwriting, and I would point out questions and things that I would tell them to ask. And as the meetup grew bigger and bigger and bigger, and more people were wanting my time, and it was really killing my days doing this, I decided to just go ahead and write it all down and put it into a book. So that's why I have my book, Backstage Guide to Real Estate. And in that book, I've got this toolbox at the back that really gets in the nitty-gritty of the deals. It tells you questions that you're going to want to ask the sponsor. It talks about different things like depreciation. I also have a blog on my website where I have a lot of free information on things like that you could check out. But, you know, the top 10 reasons why someone might want to invest passively, here's the top 10 signs that passive investing might be right for you. Number one, if you've got money sitting in the bank. Number two, if you've maxed out your 401k. Number three, let's say your retirement's solely in stocks and bonds. Hey, maybe you want to diversify. Number four, if you can't work anymore, you're working as many hours as you can per day, and you're limiting your income. So go ahead and get some passive income. Or maybe you want to reduce your work hours. Maybe you're like, I don't want to work 40 hours a week. I want to work 30 hours a week. Well, maybe you can do that if you can supplement that with passive income. Maybe you don't like Wall Street. You don't trust them, right? So you can go ahead and get some passive investments. If you're uncertain about your career, your future. For me, being in the advertising world, it's kind of weird, but I was 40 years old. I was a dinosaur. There's not a lot of 40-year-old guys in advertising. It's mainly younger people. So I was like, hey, how long do I stay in the advertising world? I don't know. Maybe you're unhappy with your job, or maybe you watch real estate shows. If you like watching real estate shows, hey, you can start flipping and fixing properties. If you already know you qualify as an investor, to get involved in the syndications, you have to be either a sophisticated investor or an accredited investor. Otherwise, you cannot participate in these syndications. So accredited investor has a certain income thresholds that you need to have. Sophisticated investor does not have any sort of income or net worth thresholds, but you have to know what you're doing. And so it's really important, especially if you're not accredited, but even if you are accredited, to be educated. And that's one of the reasons why I love Left Field. They put together all these things like this Lunch and Learn, but many, many, many opportunities to go ahead and get yourself educated on passive investing and really learn how to do it. But the bottom line on all this stuff, guys, is it's up to you, right? It's up to you. However you want to pursue this, whatever you want to do in your life, it's going to be your story. That's the tagline for my book. Part of it is write your own story. And so you need to figure out, what is your story? What's your story going to be? What are you going to be about? What kind of things are you going to invest in? And hopefully, if you can generate enough passive income, you'll be able to start giving back. I have a friend who is a real estate guy, and he's achieved, financial freedom and quit his W-2 job, and he loves animals. That's like his thing. I mean, I like animals, but I mean, he's like an animal guy, right? And so he donates money and time to all these different causes that have to do with wildlife, preserving wildlife, helping out in dog shelters, and all kinds of stuff, right? That's what he does. That's what he's passionate about. Me, I'm passionate about art. I love the theater. I love the theater's aptitude to go ahead and bolster social change. That's important to me. That's something I feel passionate about. So I get involved in theatrical pursuits. But you need to figure out what's interesting to you and what's your story. That's about it. That's my presentation today. So hopefully, as a busy person, as a busy professional, you got kind of a good outlook of all the different sort of real estate options that are available, and maybe some of the pros and cons on it. But I really want to open this up now for a discussion to answer questions that people might have.
Excellent. That was great, Matt. Just to see all of the different ways that you got into real estate, and it's similar. I think a lot of us began, I began as an accidental landlord. I did a flip that made hundreds of dollars, which not the goal, right? I did an STR. I didn't do a house hack. I did turnkeys. And then I found syndication. And, that's what really opened up my eyes and made me realize that's what I want to do. So I think it's kind of a journey. So I guess my first question is, do you think you would have gotten to this place without having tried all those other things? I mean, those are all different almost asset classes, right? STR, flip, house hack, turnkey. Would you have gotten to where you are as a passive investor and a GP, an LP and a GP, if you hadn't done all that?
I think it's possible for somebody to do that, right? I know people who've gotten involved, straight into syndications, but I don't know that I would have gotten to where I am had I not had the experiences that I had. I mean, the first one that I talk about was the thing that was really I had always heard real estate investing is great, but until you do it and that you get that check and you're like, whoa, that was an important part for me, you know. And then the next thing, which was the rental house, that's when I was like, okay, this is how you rent things, but definitely get property management. I mean, each thing was a stepping stone, and I learned more and more along the journey, which was unbelievably beneficial.
Right.
So no, I don't know that I would be where I am had I not. I mean, I don't know what would have happened, but I think each of those steps along the way were pivotal. Doing the fix and flips was great because I really understood the renovation of the units. I mean, I also knew about them from the building of the house, but being involved in the fix and flips, because that's what we do on a lot of our properties. We're doing value add on these multifamily units. And so I know what it's like and what the costs are to do these different things. So that was, all of it was instrumental, really.
Yeah. Well, let's open it up to broader questions. And I would just say that, you know, it's not very often, and maybe so far never, that we have a GP who's also an LP. So we can really ask some questions that, you know, because Matt, you're on both sides of these transactions, and that gives you, you know, some real knowledge that maybe we don't have. So if you're interested in asking a question, you can either put it in the chat and I can read it, or you can just unmute and ask it. But I will get things started with one of the questions that I think most people in left field investors have asked at one point or the other. But how do you vet a sponsor? So somebody new that you maybe have never heard of, they weren't recommended to you, they send you an email and you're like, that sounds interesting. How do you get started with them?
Yeah, you know, it's like I said, I talk about it in the book. It's one of the most important things that you're going to do. And I actually have some questions in the book that you'd want to ask a sponsor. But you put me on the spot. Let's see if I can remember all of them, or at least I'll remember some of them. And the first thing I say is, how did you meet that sponsor? Right? How did you meet them? Did they send you? So in the book, I have this thing. It's like, it's a guide. So it has the questions that you ask, and then it's like, thumbs up means good, you know, and then fingers crossed, like, I don't know, and thumbs down, right? So thumbs down, like on how you met the sponsor, is like, oh, I got this random spam email, right? Like, some guy you never met before sends you a random email. Hey, I've got this great real estate deal. That's a, I don't know, you know, a big warning sign for me. But let's say, you know, Jim Pfeiffer told you, hey, I invested with John Doe, and John Doe's an awesome sponsor, really communicative. I got great returns. I've continued to invest with him. Like, then I'm like, Jim, give me John Doe's email, please. Like, I want to talk with John Doe because he had that experience, right? And that's the great thing about left field investors, is you've got this community of people. I may be the only one who's a sponsor who's actually in the infield. I don't know if there's any other sponsors, but like, legit, 2/3 of my portfolio are passive investments. It's totally from that perspective. I don't comment on things because there is kind of that, you know, I don't want to cross the line on anything. So I try to keep quiet, but I read a lot of what's going on. And I want to hear, you know, what sponsors different people have invested in, and what's gone on, what's happened, what was the actual, you know, people can put whatever they want in a pro forma. We're projecting, you know, a 4x equity multiple. Yeah, but are they delivering on that? If they are, great, let me do more of that. So having that candid feedback from people like Jim and all the other, I mean, so many great left field members, they don't have anything to win by doing this, by telling you that sponsor X is good or bad. So that's where I would start, is on the left field forums, start talking there. But so how did you meet the person's really important track record, which is what I just alluded to? How have their deals performed in the past? Now, past performance does not guarantee that's how they're going to continue in the future. But if the past performance has been bad on a regular basis, then that's probably a warning sign, right? There can be, you know, issues. There can be deals that don't go well. People can learn from those, you know, but if you're seeing those time and time and time again, then I would worry. People who have good track records, that are doing well consistently over time, that's important. And the most important thing, I think, is making sure that you're aligned with that investor, with that, the sponsor's sort of like philosophy and approach, right? So, different people are going to approach deals different ways. Some people operate their properties, I've seen situations where people operate property, do very well, they make a lot of money, but they make their money by really reducing their costs, right? Because the name of the game is to improve your net operating income. That's going to improve your value on your property. So there's two ways you can do that. You can reduce costs, which we're always looking to do, or you can increase the income. But there are people who spend so much time reducing the cost that they're actually like making the residents of the property, putting them in what I consider a subpar property. Some people might call people like this slumlords, right? Where they're just reducing the services, reducing staff. Oh, we don't need 3 maintenance guys. We can get by with 1 maintenance guy and a part-time guy, but it's a 300 unit property, right? They need 3 or 4 or 5 full-time people. And I've seen things like this, and I've chosen personally not to invest in those. And those deals have done well. And I know people who've invested in them and made a lot of money. And that's great. But for me as an investor, it's just not aligned with who I am and who I kind of want to be in the world. And there's plenty of other investment opportunities out there. And so that's how I sort of choose who I'm investing with. So you just want to make sure you're aligned with. If all you care about is those dollars and cents coming into your pocket and you don't care about that other stuff, then go ahead and invest with that guy. I mean, that's your personal choice on what you want to do, but just make sure you understand where you are, what you want to do, and what you stand for, and what that sponsor is, and see if there's an alignment there. And that doesn't go for just like how they're treating tenants, but like what's their communication style? What are they? I mean, if they're like a really arrogant asshole who doesn't have the time to like talk with you on the phone, like, is that someone you necessarily want to invest with? I don't know. Maybe not. So. Maybe you're a really arrogant jerk too. So 2 pieces of pie, I don't know. But I'm just saying, you want to kind of get to know that sponsor, understand who they are, what they're about. I know, Jim, you say this a lot, know, like, and trust, right? And so that's important. Someone that you know, someone that you like, and someone that you trust. So those are some tips around the sponsor.
That's great. And, alignment is one that isn't really talked about that much. And it's critical, right? And that's where left field investors can come in and help you find sponsors and vet sponsors. But as you said, I think this is a really good point, is that, as one sponsor I might really like, but they're not aligned with me, but they're aligned with how you think of things. And so it might be a good sponsor for you, but not so for me. And I think we just need to make sure we're looking at that. So that was a great point. We have a few more questions here. How important have you found your project management experience to be in your success as a GP?
Oh, that's a nice question. Thank you. So yeah, I do. I am a PMI certified project management professional, which means I'm really good at managing people, budgets, and timelines. And so people with that PMI certification are in many different fields, right? People who are in construction do it. People who manage digital marketing projects, like I did, do it. There are many different fields. And so what it really is codifying and teaching certain skills and a skill set that can be applied to different things. So for me, I applied all of that to the digital marketing world and doing projects in digital marketing. And I did real estate as a hobby for 10 years while I was doing that. And then when I started doing real estate full time, I started applying that. As a matter of fact, I hired a director of operations who I worked with in those days, back in the advertising days, because he is an amazing project manager. And, a lot of what I do is managing the assets. So, there are some people out there who are really more on the, capital raising side of things, which, you're really not allowed to just capital raise. You have to have other roles. But there are people who are maybe more focused on just like acquisition or, marketing or different things like that. And I'm involved in all of that. But I'm very, very deeply involved in the asset management on all the properties, and having that project management toolbox to use and using those skills. And I've taken a lot of the tools and tricks and tips that I've learned in project management and just applied it to real estate versus digital marketing. And it's been very helpful in us making sure that our operations are moving smoothly. So, you know, it's one thing to underwrite a deal. This is something that I learned the hard way as a passive investor. It's one thing to underwrite a deal. It's another thing to actually operate the deal, actually execute that business plan. And you need to make sure people are executing it and executing it well. And so, yeah, I think if you're looking at a team and one of them's a professional project manager, it's a good thing. And it's been crucial, I think, in the success of the projects I've been involved in.
Another question from the chat. Describe how you approach investing as an LP differently now since becoming a GP and knowing all that goes into that side of the business.
Yeah, so I asked for the underwriting, and most of the people that I'm involved with know that I'm going to ask for the underwriting and that I syndicate deals. Some people don't want to share it, which I understand, but I at least, like, if they don't want to share the actual Excel spreadsheet, but I at least want a PDF of it, because sometimes people have proprietary stuff. I know I don't love sharing mine in Excel format, but I'll PDF it and send it off to people. So one of the things is, like, but you very seldomly will see when sponsors are doing deals, the T3 and the T12. It's very seldom that they're going to present that.
Hey, Matt, real quick, what's a T3 and T12?
Thank you. I was using jargon. I'm glad you pointed that out. So the T12 is your trailing 12 months of your P&L, which is your profit and loss statement. So instead of it just being, here's our profits for the whole year, it actually breaks it down every month. Okay. So that's your T12, and your T3 is just the trailing 3 months. You know, if you're buying a property, the T3 is probably more indicative as to how it's performing right now versus how it was performing a year ago. But you also want to look at the T12, especially when it comes to, like, expenses. Maybe it's up north. And so during the winter, the snowplow bill is really expensive. And that's just like one example, right? But there can be changes to costs and things like that throughout the year, which is why you want the T12. But I like to look at the T3 and the T12 and understand where the property is starting. There is a very well-known syndicator. I don't know. I'm sure you have him on the left field list. Good guy, has had deals that do really well. And I wanted to do a deal with them. And this is just one of their deals. The other ones are probably fine, but whatever. Like, he sent me the deal. I looked at the deal. I underwrote the deal. Deal looked good. You know, they're underwriting. I saw their underwriting. I was like, oh, this looks good. You know, I was getting ready to invest. And I said, hey, can you send me the T12 and the T3? And so one of the things that I look for, and I detail a lot of these things in my book, is I want to see the year-over-year increase in income. I really don't want to see it more than 10%, okay? Because that's, I mean, they've got to have a really good excuse for rate, you know, if income is going to go up more than 10% in any given year. It's nearly impossible to do. It's very, very difficult. I've never seen anyone do it. Unless you're buying like a 6-unit property and like 3 of the units are empty, then maybe you could do it. But the guy sent me the T12, and I looked at the trailing 12 income, and then I looked at his year 1 income, and it was like a 40% increase. So even though the increases from year to year, once he had it, made sense. I'm like, how are you going from, you know, how are you getting a 40% increase in year 1? You know, I didn't even get into it with him. I just like, I left it alone. But, you know, they're like, oh, well, we're going to value add the property, you know, we're going to increase rents. But the thing you got to understand is, like, if you have a property that's like 90% occupied, hopefully it's stabilized. Maybe it's not. If it's not, then maybe I can understand that. But he had a stabilized property. And so it's not like day one he's going to go in and kick everybody out of the property. I mean, he can't. It's against the law. They have leases. But what's going to happen is, as leases turn over every month, he'll have an opportunity to renovate some of the units. Maybe he doesn't allow anybody to renew, which I think would be foolish, because his vacancy would be extremely high that first year, right? So that person, to try to get a 40% increase is really difficult in year one. A lot of times when I'm underwriting deals, my year one is like very low. It's like 5%, because it takes a while. You got to get into the property. The other thing to keep in mind is, let's say you close on a property January 1st. You're going to be renewing leases probably for March or April at that point. Unless the former sponsor did a really bad job, their January and February leases are already in place, and maybe partial March. So you're going to be starting in March or April. So you're already 3 months in before you even start increasing your income. So, there's a lot of things like that as a sponsor, that's just one example, but there's a lot of things that as a sponsor, I know, because I do it, and I can just dig in a little bit more. And I really don't mean to be like plugging the book so hard, but like, that's the point of the book. The point of the book is for people who are passive investors to be able to like look at a deal and peer behind a curtain and see how the underwriting's been done, to see if you feel comfortable with it or not. And there's been deals that I've seen where there's been red flags that have come up, and I've sat down, I talked with the sponsor, they explained to me why they did things that initially had made me cautious, and explained it so well that I went and invested with them. And talking about a particular deal that just sold a few weeks ago, we owned it for 2 years, and I tripled my investment in it. So it's not that every time there's a red flag, it means don't do the deal, but it means, hey, this is sort of out of the norm. You need to talk with your sponsor. You need to make sure you feel comfortable with what they're doing, what their approach is, and their why. And if they can articulate that in a way that makes sense to you, then maybe it's perfectly fine to move forward with it.
We're getting towards the end, but I got a multi-part question here. Other than yourself, name one or more sponsor you would invest your own money with. And other than multifamily and Broadway, are you looking to invest in other asset classes? And what asset classes are you avoiding?
Okay. As a general policy, I tell everybody who asks me which sponsors I would recommend, I tell them to go to Left Field Investors and talk with the team there. I have many personal and business connections with so many different sponsors. It's just, I don't think it would be right for me to say something. And if I forget someone might get upset. I stay away from it.
Fair enough.
Yeah. In terms of my investments as a limited partner, I mainly invest in multifamily. I do invest in Broadway as well. I have been looking and have invested in some other things. I've been doing a lot. One of the things that I would like to do longer term is looking at some ground up construction type of deals. So I've been investing as a limited partner in a lot of properties that, and starting off early where it's a bit more riskier, where they're like going through entitlements. I'm learning a lot through that process, which is good. That's how I learned a lot about multifamily. That was part of my education. Part of my education was investing in deals as a limited partner and learning from that. So those are interesting to me. Self-storage, mobile home parks, all of those things. I've yet to see an operator that's like just blown me out of the water. Oh my gosh, they're so amazing. I have to do that. And when there's also so many multifamily people doing it, and I know the multifamily and I can underwrite it better. Someone was asking me something about self-storage, like if I would co-sponsor them on a self-storage deal, or I don't know, something like that. And I was like, I don't really know self-storage. Like, I mean, there's a lot of different nuances to it that I don't understand, right? So if I was going to get involved with it, there's actually, you guys have a really good operator on left field who I'm actually thinking about doing a deal with. But I don't understand it as well, so I can't look at the underwriting as well. I feel like I can look at a multifamily deal and have a really good understanding of if it's going to be possible or not. And I don't have that yet in the other asset classes.
That makes sense. Okay, we're about out of time, Matt. This has been great. We got one more question we'll squeeze in. How's this? How is your underwriting changed in the current rising rate environment with the possibility of rates being double at the time of refi or sale?
I don't know about rates being doubled, but I'll tell you this. I have not changed my underwriting at all, which some people might be shocked by my underwriting. And I've looked at it and I've considered it. My underwriting has always been conservative. I always look for historical norms, right? I look at what is the average cap rate? What is the average rent growth? And I write to that, which is why we've been able to exit our deals that were projected for 5 to 6 years. I've been exiting them in like 2 years, 2 to 3 years. Because of that, because I was being maybe too conservative and I wasn't getting as many deals because I wasn't underwriting aggressively. So now when I look at it, I still am always thinking about what I'm doing. How am I looking at things? I am making sure I have a little bit more reserves. I don't do deals that require a refinance. I never have, I never will. Requiring a refinance in year 3 for a deal to be successful, I wrote a whole blog post about it. It's like believing in unicorns. And I use that unicorn as the image for the blog post. Like it's that's when you get in. What I was talking about when I wrote that about 6 months ago before this whole thing is exactly what's happening now. People who were like 2.5 years ago, 3 years ago saying, oh, we're going to refinance in year 3. And then that's, meanwhile, they were only getting 1% cash on cash. And then they were going to have this big refinance. And now they can't because they never expected interest rates to go up this high. All of my deals are also like long-term, right? So we're looking at 5 years or more. So I don't think that interest rates are going to be double where they are now 5 years from now. They might be, but we'll force enough appreciation through our value add to still have a very profitable venture.
All right, perfect. With 1 minute to spare, I like to keep this to an hour. So Matt, this has been fantastic. Everybody on the call, his phone number is there on that slide, as is his email. I encourage you to reach out to him. He is, as you can tell, willing to give his time and knowledge to our community and others. And we appreciate, Matt, all that you do for Left Field Investors. And we cannot wait to see you in Columbus 1 month from today.
I am very much looking forward to it. One thing I'll say real quick, just a quick plug. I have a newsletter that goes out every month that's got those articles that I talk about that are really educational and good for investors. So if you head on over to picheny.com, you can sign up to get that free newsletter.
And I'll vouch for that. I get those, and they are good, and I would recommend that everybody do that as well. So thank you very much, Matt. We will, like I said, we'll see you in a month, and thank you everybody for joining us. We'll see you next time in the Left Field.
Thanks.